Ladies and gentlemen, welcome back to Chasing Financial Freedom. Today, another day in the stock market. It is Monday and we are into Money Monday. So, we're going to see where can money be made in the stock market. So, the first news that has caught our attention is what Warren Buffett said about the Buffett indicator. Let's look at it. Monday, April 12th. The ratio has certain limitations in telling you what you need to know. Who wouldn't love to replicate the investing success achieved by billionaire Warren Buffett? This is why investors are drawn to stories about the Buffett indicator. Lately, the Buffett indicator has been flashing a warning sign about the stock market. Many outlets have been reporting on this, including Fortune, Bloomberg, The Wall Street Journal, Business Insider, MarketWatch, and even Yahoo Finance. For those catching up, the Buffett indicator is the value of a country's publicly traded stocks divided by its gross national product, and different people have different ways of accounting for those inputs. This ratio first became associated with Buffett in 2001 interview with Fortune's Carol Loomis, where the investor characterized the ratio as probably the best single measure of where valuations stand at any given moment. At the time, he noted the ratio was very high in the late 1990s, portending the dot-com bubble which eventually burst. And now that this ratio is exceeding the levels seen during that era, people are sounding alarm again. Even Elon Musk has put a spotlight on the metric via tweet. Let's look. But should investors really be worried? Let's look at tweet. Blah blah. What do you think of the unusually high ratio S&P market cap to GDP? And here, but ARK Invest Katie Wood responded to Musk by questioning the ratio's efficacy in a series of tweets last month and last night. GDP statistics evolved during the industrial age and do not seem to be keeping up with the digital age, Wood said on Twitter. Thanks to productivity, real GDP growth probably is higher and inflation lower than reported, suggesting that the quality of earnings has increased significantly. What does Warren Buffett think about this? Buffett actually made some important statements about the metric, which often gets overlooked. The ratio has certain limitations in telling you what you need to know, he said in 2001 Fortune interview. At the time, he didn't give specifics, but one thing is clear, it's not the be-all and end of all predictors of market peaks. At the 2017 Berkshire Hathaway annual shareholders meetings, Buffett fielded a question about the Buffett indicator as well as Robert Shiller's legendary CAPE ratio. He had this to say: every number has some degree of meaning. It means more sometimes than others. And both of the things that you mentioned get bandied around a lot. It's not that they are unimportant. They can be very important. So it is important to put the emphasis on the can. Sometimes they can be almost totally unimportant. It's just not quite as simple as having one or two formulas and then saying the market is undervalued or overvalued. In that response, Buffett went on to say, the most important thing is future interest rates, arguing that low interest rates justify higher valuations. And this is actually what we are seeing right now. When the yields has gone up or the interest rates has gone up, we're seeing that the valuations get a little bit lower. My colleague Brian Sozzi also made a critical observation in reporting on the Buffett indicator, noting that Buffett has been buying stocks despite his namesake indicator being so high. Yes, it's always very important to look at what people are doing, not what people are saying. In this instance, buying is, for example, buying Apple stocks. You would think that if Buffett was worried about the Buffett indicator, he would be dumping stocks, but that's not what's happening. At the end of 2020, Berkshire Hathaway had a stock portfolio worth 280 billion, up from 248 billion the year prior. So, who knows, perhaps Buffett will change his decades-long bullish tone on the stock market at Berkshire Hathaway annual shareholders meeting. So, the bottom line is you shouldn't jump to conclusions based on a cursory reading of a single ratio. So, it's much more complicated than that. So, if you look at the stock market, it looks like that it's going to go up. So, stock futures pull back from record levels. China's end to become financial holding firm under enforced revamp. Why stocks are at a record high even though higher tax loom? Because taxes are not as high as they have predicted. They were talking about 40 to 45% income tax for the companies, and yet we're talking on a small increment from 21% to 27%. And even though most big firms have their money outside, so it's they have the taxes optimized, so it's not as bad as they would like to tell us. So Dow set to edge back to kick off earnings week as Powell says US economy at inflection point. So what does Joe Powell says? Article from MarketWatch. So the US stock index futures on Monday were heading modestly lower in a week that will see the unofficial start of first quarter earnings, headlined by some of the nation's largest banks, including JP Morgan Chase and Goldman Sachs. Yes, this week is important because this week we will see how the tone for the next quarter or maybe for the whole year will be. Market participants were also waiting comments from Federal Reserve Chairman Jerome Powell, who spoke during a 60-minute interview that aired on Sunday. How are the stock benchmarks performing? On Friday, the S&P booked a 2.7 weekly gain. The Dow rose 2% and the Nasdaq Composite logged a 3.1 weekly rise. The S&P 500 and the Dow booked their third straight weekly gain, while the Nasdaq has climbed for 2 weeks in a row. So, the question that this author is asking is, what's driving the market? On Sunday, Powell said that the economy is going to start growing strongly in the second half of the year. So, we are probably going to see a rebound in the prices of the airlines and cruise lines, but emphasized that the rebound shouldn't lead anyone to believe that central banks would dial up interest rates in 2021. I think it's unlikely that we would raise rates anything like this year, Powell said during the 60 Minutes interview, which was taped at the Fed's headquarters on Wednesday and aired Sunday evening. The Fed boss said the economy seems to be at an inflection point, with strong growth coming right now and the weakness caused by the coronavirus pandemic in the rear window mirror. Powell's comments come as Wall Street is positioned for the start of first quarter corporate results, which could offer further clues about whether one of the market's biggest fears is coming to fruition: a too hot economy and surge in inflation that compels policymakers to substantially dial back rates and accommodative policies ahead of the Fed's projections around 2023. So far, the Fed officials have said they expected a rise in inflation to be transitory and have repeatedly stated that they would be focused on ensuring that the labor market makes a full recovery before considering easing policy. Some strategists fear, however, that stock valuations remain elevated despite uncertainties that include inflation and the tax regime. Stocks mostly ended at records last week, and the Nasdaq Composite, after falling into correction in March, defined as a drop of at least 10% from a recent peak, stands less than 2% from its February. 12 all-time closing highs. Gains for equity benchmark have come despite concerns about the out-of-control inflation and the possibility that President Joe Biden will raise the corporate tax rate to 28 from 21 to help fund his $2.4 trillion infrastructure proposal. The investment community is too a bit, in our opinion, not showing any concern for plausible tax increases being proposed by the Biden administration, wrote Citigroup research analyst Tobias Levkovich. Lorraine Schmidt and Jennifer Stamper in his research note dated April 7. Indeed, all developments are perceived as positive news, yet such one-sided views are not usually a good starting point, the city researchers wrote. Meanwhile, Germany was preparing new COVID-inspired legislation which would enable the Eurozone's largest economy to impose national restrictions without regional government approval. England, meanwhile, reopened pubs for outdoor drinking and hairdressers. So, which companies are in focus? We have Nuance Communications, Microsoft Corporation, Regeneron Pharmaceuticals, Uber Technologies. Okay. Let's look at the Nasdaq, because if we are into growth stocks, we should be looking at the Nasdaq Composite. And if you look at the stock charts, we can see that we are right now under the VWAP. So we are trending relatively good. And if we take one day chart, we are still at a one-time high, but as we have predicted in our some of our videos before, as you can see here, we have seen a similar movement that has happened here. So we are probably going to see a W-shaped recovery and then move up. So remember, the stock market is never moving straight up. It has never been, and it will probably never be. So right now it looks like the stock market is relatively healthy. As you see here, we are doing relatively well. Well, you could say that we are probably going a little bit into a retraction because of this shadow here and this this candle right here. So this week may be a little bit red, but we will be sure to be back. So until next time, we wish you great luck in the stock market. Please subscribe or let us your like if you feel that you have gained some value from this video. Until next time, see ya.